Four straight weekly losses. The S&P 500 just posted its worst stretch since October of 2023. And a rain-driven oil shock pushed Brent crude to 106. The Fed confirmed rates are staying put, and gold crashed 11% in a single week, entering a bear market. Fear and greed hit 15, which is extreme fear. Only 13% of the S&P 500 stocks are above their 20-day moving averages. And against all that, the ValueAligned portfolio performed just as well as the S&P. I'm going to walk you through exactly what happened, why it happened, and what it means for your money heading into next week. This was a week where everything that could push markets lower did. An Iran-driven energy shock reshaped inflation expectations mid-flight. The Fed confirmed rates aren't moving anytime soon. Gold miners got cut in half in just 3 weeks. And the VAP, the portfolio, held up slightly better than the index. It was down 1.8 versus the S&P's 1.9%. The divergence between energy-exposed names and the rest of the portfolio is going to matter over the next several months. All four major index ETFs closed the week lower. Spider, the cap-weighted S&P 500, fell 2.1%. The equal-weighted version dropped less at 1.6%. The 50 basis point gap tells you something specific, that large cap growth stocks took disproportionate damage. NVIDIA, Microsoft, Apple, Amazon, and Google. They all felt the pressure of rising yields and fading rate cut hopes. Triple Q fell 2% at the negative 5.3% year to date. Tech-heavy growth investors have had a rougher start to 2026 than even the headline suggests. IWM, the Russell 2000 small cap stocks, dropped 1.8%. Small caps tracked large caps very closely, though the market was bad across the board last week. When rising rates and inflation are the concern, size doesn't really provide much shelter. Quality and sector exposure do, sort of. Breadth confirmed the damage. Only 32% of S&P 500 stocks closed higher for the week. Just 13% were trading above the 20-day moving average. Oil services firms through OIH gained 4.3%. MLPs and airlines showed far more muted responses, however. They consume oil as an input cost, not sell it as a product, so they didn't do so well. Financial squeezed out a small gain at plus 0.4. Alternative asset managers drove the recovery midweek. On the other end, utilities fell 4.9%, and consumer staples dropped 4.1%. That outcome is almost entirely rate-driven. The 10-year yield surged to 4.4%, and yield-sensitive dividend sectors became less attractive relative to the risk-free 4.4% return. The selling was mechanical. Materials lost 4.5%, dragged by the gold miner collapse. Healthcare fell 3%, hit by the Eli Lilly downgrade and broad risk-off pressure. The 5 biggest winners in the S&P 500 this week told 2 stories: energy supply disruption and AI infrastructure spending. Venture Global, ticker VG, gained 21%. 3 catalysts drove it. The company announced a final investment decision for Phase 2 of its CP2 LNG project, $21 billion in total financing. The Department of Energy approved a 13% increase in export capacity. And Iran's attack on Qatar's Ras Laffan LNG facility sent Asian buyers scrambling for U.S. supply alternatives. ARM Holdings, semiconductors, jumped 4.3%. HSBC upgraded the stock, arguing the market is underestimating ARM's shift from mobile royalty collector to AI data center CPU supplier. CPU shipments are forecast to grow 20% in 2026. And Ciena, CIEN, gained nearly 14%. Revenue hit $1.3 billion, up 33% year over year. Unbelievable. Cloud provider revenue surged 76%. Lumentum, LITE, rose 13.5% ahead of the S&P 500 inclusion come Monday. NVIDIA's $2 billion investment anchors the bull case for Lumentum. Cheniere Energy, LNG, hit an all-time high, up 11.4%. Same structural dynamic as VG. Asian buyers desperate for U.S. LNG alternatives to Strait of Hormuz supply. The bottom 5 were dominated by golds and silver miners. 4 of the 5 names. Wheaton Precious Metals, WPM, fell 18.1%. Wheaton is a streaming company. Its costs are fixed, which makes it a violent instrument when gold moves sharply in either direction. AU, Anglo Gold Ashanti, dropped 15.7%. Newmont, the world's largest gold miner, fell 12.6% and broke below 100 for the first time in months. Kinross lost 13.2%, And out of only the Barnes Group, a diversified industrial manufacturer, rounded out the bottom five at minus 12.3%. Three forces converged. Gold itself crashed 7% intraday on March 19th, a flash crash driven by algorithmic selling. The hawkish Fed raised the opportunity cost of holding gold. And here's the structural irony. The same oil shock that initially drove gold higher as an inflation hedge now hurts miners operationally. Diesel fuel costs jumped almost 14% in February, in the February PPI. Energy is a major fraction of mining costs. Gold is now down 20% from its January peak, and that meets the technical definition of gold is in a bear market, which is unbelievable because of how well it was doing. February's producer price index came in materially hotter than expected. The timing made it worse. It landed simultaneously with the Federal Open Market Committee of the Federal Reserve's announcement about interest rates. Final demand, month over month, plus 0.7% versus the 0.3% consensus. That was much hotter. Year over year, it was plus 3.4%. And the core producer price index, stripping out food and energy, hit plus 3.9% year over year, which was above the 3.7% estimate. Goods surged 1.1%, the largest monthly jump since August of 2023. Fresh vegetables spiked 49%. Diesel fuel added, like we said, 14%, and jet fuel rose sharply as well. What matters for the bigger picture, this was the 10th consecutive monthly advance in core PPI. The pipeline pressure is broad and persistent. I was working with a client recently who asked me whether the CPI number from the week before meant inflation was beaten. The answer is no. CPI was collected before the Iran war's energy impact filtered through. PPI is collected later in the chain. The gap between a benign CPI and a hot PPI tells you the headline CPI numbers coming in April will look a lot different. February payrolls came in at negative 92,000, you might remember. Unemployment rose to 4.4%. Softening in employment and sticky producer prices, that puts the Fed in a situation it does not want to be in. The Fed held rates steady at 3.5 to 3.75%. That was expected. The lone dissent came from Stephen Miran, who voted to cut, actually. The updated projections moved the needle. Inflation forecast rose. 2026 PCE inflation went from 2.4% to 2.7%. The core PCE went from 2.5% to 2.7%, and gross domestic product barely moved. Unemployment stayed unchanged at 4.4%. And Powell's press conference after they had the decision about rates drove the selling. On stagflation, he pushed back, though. This term originated in the 1970s when unemployment was not 4.4% like today. It was in double digits. Employment's at normal levels with inflation just 1 percentage point above the Fed's target, so we can't really say we have stagflation. He reserved the label for far more severe circumstances. On Iran, it was too early to determine the extent and duration of these economic effects. The Dow dropped 600 points during the press conference. Friday added another 447 points down. It's over 1,000 points on the Dow in just 2 days. The 10-year Treasury yield moved from 4.2% on Monday to 4.4% by Friday, 16 basis points in 1 week. That's a pretty big move. 14 of those arrived in Friday's session alone. The second year held near 3.9%. The curve stayed positive at roughly 51 basis points, which means that the longer-term yields are higher than the shorter term. The U.S. and Israel launched strikes on Iran, we know, on February 28th. That date marks the start of the single most consequential macro factor right now, of course. Iran's closure of the Strait of Hormuz disrupted approximately 1/5, 20% of the global oil supply and a significant portion of liquid natural gas flows, that's LNG. It was near $72 before the conflict. It surged to $106 in under 3 weeks, which is a 47% jump in oil prices. U.S. gasoline crossed $4 per gallon. This morning I filled up at $4.10 in Lincroft, New Jersey, per gallon for the first time since late 2023. Production from Kuwait, Iraq, Saudi Arabia, and the UAE dropped at least 10 million barrels per day by March 12th. The range of outcomes here is very, very wide. A research company called Capital Economics says a brief conflict followed by a ceasefire puts the oil back at $65 by year end. A prolonged conflict pushes oil to $130 in Q2, adding another full percentage point or more to headline CPI. What we told the client this week, the oil scenario you plan for determines everything else in your portfolio position. But, the point is if you guys have your plan in place, we are the ones that determine your portfolio positioning. And for the most part, we're doing nothing except getting ready to buy some really cheap quality stocks. At $65, the rate cuts come back on the table. At $130, they don't, meaning the oil prices. Gold experienced a flash crash during early New York trading on March 19th. It fell 7% intraday to $4,558 per ounce. Silver dropped 12.5% in the same session. Gold ended the week down 11% at roughly $4,492. That's 20% below its January 29th all-time high, near $5,589. On Ukraine, the Iran war pulled attention and resources away. The Kremlin confirmed on March 19th that talks are on a situational pause. Polymarket puts the probability of a ceasefire by March 31st. Polymarket is one of those platforms where people can bet on different things. So the Polymarket puts the probability of a ceasefire by March 31st at only 1%. These things are right a lot of times. U.S.-China trade talks took place in Paris on March 15th and 16th. China warned that Section 301 probes could damage trade ties. AMD chip export restrictions to China take effect in the second quarter, and that's a real constraint on one of our VAP holdings, AMD. Now, the flash PMIs, that's what we call them, PMIs, are the Purchasing Managers Indexes. They come out for March on March 24th, and they're the most significant data point on next week's calendar. Prior, manufacturing were 51.6, services were 51.7, composite was 51.9, all in modest expansion territory, which is good news. Those numbers were collected, however, before the Iran war began. The March flash data will be the first real-time window into how businesses have responded to $106 oil energy supply disruption and the geopolitical shock. Consensus expects the composite to step down to around 50.5. Any reading below 50 in manufacturing signals contraction, meaning we have a recession in manufacturing itself. So we've got to also watch the price components very closely in these flash PMIs. If businesses are passing energy costs through aggressively, it shows up in the input-output price indices. The bull path, the PMIs hold above 50. There's diplomatic movement on Hormuz. Oil drops, inflation pressure eases. With 13% of stocks above their 20-day moving average and fear and greed at 15, which is really fearful, but very bullish. Now, the ValueAligned portfolio that many of you are invested in returned negative 1.8% for the week. That was a big weekly loss that we had. The S&P 500, which a lot of people call the market, returned a negative 1.9%. Against the brutal tape, the slight outperformance came almost entirely from our energy exposure. Top contributors, Diamondback Energy, which has the cool ticker symbol FANG, FANG, gained 5.6%. Permian Oil, well, another Iranian war tailwind. KKR, the alternative investment house, rose 4.7% on the Apollo ICE private credit announcement. In other words, private credit scare became less scary last week. AMD added 4.1% on hedge fund accumulation and the Meta, that's the Facebook parent company, GPU deal. And Permian Resources, PR, gained 3.7%, now up 43% year to date. The bottom detractors were Kinsale Capital, KNSL. It fell 9.5% for the week after Jefferies, brokerage firm, downgraded it to underperform with a $312 target. IBP, that's Installed Building Products, it's the guys that put in the insulation in both housing and industrial sites, dropped 9.1%. RBC, the Royal Bank of Canada, had an underperform rating, and the CEO of IBP, and that's a family-owned business. The CEO there founded the business, and he sold 400,000 shares worth $125 million. That's a lot of shares. Eli Lilly lost 8% on the HSBC downgrade to a reduce, and AutoZone, haven't heard that in a while, fell 7.9% on a domestic same-store sales miss. Tesla dropped nearly 6%, breaking below $390 support. Diamondback, which is FANG, is a pure-play Permian Basin oil and natural gas play. At $106 oil, realized prices are substantially above their break-evens, generating outsized free cash flow. And the 11 million share secondary offering that had been a technical overhang cleared on March 12th. So that's why FANG is going up. EPS estimates have moved up 10% in just 30 days. Now the forward PE is around 19 times. Now its cousin, the smaller cousin, Permian Resources, PR, had a record production of 189,000 barrels per day in Q4 2025. Drilling costs, which is so important, were cut to $700 per foot, targeting $675. So they're at $700 now per foot of cost of drilling, and they could go down to $675 next quarter. The dividend is up already 7% to 16 cents per quarter, And the stock is up 43% already year to date. It's one of the strongest performers in the entire S&P 500. KKR, the Apollo Ice private credit infrastructure announcement shifted the narrative for all these private equity companies like KKR. Quarterly revenue of nearly $6 billion was up 76% year over year. Can you believe some of these moves in these revenues? Just unbelievable. Insiders bought. So KKR, we had some insiders buy $40 million of stock with their own money in the prior 90 days at negative 29.4% year to date. The business hasn't changed, but the macro has, of course. The portfolio behavior this week was a clean split. Energy wins, everything else struggled. FANG and PR added absolute performance in a market where almost nothing worked. The 5 bottom were driven by identifiable events, so they weren't necessarily macros. We saw analyst downgrades, a CEO share sale, an earnings miss, and technical breakdown. That granularity matters for long-term owners a little bit. It helps us explain things, and it gives us an idea, as long as we think we understand, of where we should enter some of our better stocks as long as the fundamentals get better. And that's what we're going to do. Now remember, macro sell-offs tend to recover together, and stock-specific events require a reevaluation for thesis at the individual company level, which, again, is what we did. The flash purchasing manager indexes, the PMIs on March 24th, matter more than anything else on next week's calendar. That number will tell us on a macro basis whether businesses have absorbed the oil shock or whether it's breaking through into real activity modulation. If you got value from this review, you're going to want to see this one right here, where I break down how to understand that when the quality shares goes down and fundamentals don't change, that's the time you buy it. So it's on the screen right here. We'll see you then. Bye-bye.